Welcome to another video. I wanted to take a closer look at call options, so let's dive into it. I train elite seven-figure traders on how to use powerful techniques to take their trading to the next level. I'm building this channel for those of you who aren't seven-figure traders yet, but want to learn and implement elite strategies to optimize your returns on your favorite ideas while managing risk like a pro. All right, let's dive into call options. Call options are a contract between two counterparties. There is the buyer of the option and the seller of the option. The buyer is paying money for the right to be able to buy the underlying security, while the seller receives the money as income for undertaking an obligation. So let's explain this a little more detail. So now, if I'm the buyer of an option, I am buying a contract that gives me the right to actually physically buy the shares at some point in the future. And what I'm securing is the price that I want to pay and how much time I need to decide whether to buy the shares or not. Now, of course, if I have the right to buy it, somebody undertakes the obligation to have to sell it to me. Now, the seller of the option gets paid a premium, an income, but it is being paid because they have undertaken the obligation to have to sell the shares to the call buyer when they wanted them. So let's take this out of the stock market and create a call option on something that we're all familiar with. Let's say something like your car, and it's on the lot for $20,000. We know we can cut a check or make a bank transfer for $20,000. The ownership gets signed over and you drive away and you own a car. But now, what if you like a car and you want to secure it for the purchase into the future? Well, you can approach the seller that's selling the car for $20,000, and you can say, I will pay you $1,000 if you secure this car for me and you give me over the next 1 month the right to buy that car off you for $20,000. Irrespective of whether I choose to buy it or don't buy it, you get to keep the $1,000. The seller of the car is saying, well, look, I was going to sell it for $20,000, but now I can make $20,000 on selling the car plus an additional $1,000. To them, they were incentivized to enter this options contract. You, though, have now given yourself optionality. So there are two key variables when looking at a quote of an option. It gives you the strike price and its expiration date. So the strike price is different than the stock price. The stock price is perpetually fluctuating. That's the price discovery of the market determining what the shares are worth at any one time. The strike price, though, is fixed because it's the price from which you have entered a contract with the counterparty for you to be guaranteed to be able to buy the stock in the future. And so if you bought a $120 strike price, irrespective of whether stock's at 110, 120, 130, 150, you have the right to buy it at 120. And that is inherently built right into the option. The second thing is its expiration. And the expiration of the option is how long you have to decide. Expiration matters because the more time there is on an option, the more expensive it becomes. You buying a call option that gives you the right to buy a stock for the next 3 days is going to be much cheaper than you securing an option that gives you the right to secure that price for the next 1 year. It's all relative. Now, the one thing I want to leave you with and you to take away is the fact that a lot of traders use these options as trading vehicles. They'll turn around and buy this option for $5, and a week later, they might sell it for $10, never taking the ownership of the stock. Now, that's fine. That's just traders being traders. But what gives the option value is throughout that entire time, you always had the right to buy the shares. And you could give the broker at any point, if it's an American style option, instructions to exercise your right to buy. And overnight, the clearing corporation would deliver those shares physically into your account. And so while you can buy and sell options and trade them, you should always keep in mind that you have that inherent right because that is what gives the option value. Now, to summarize, we just wanted to give a high level and simple explanation of what call options are and how they work. We're going to get into a little bit more detail in the upcoming videos.